Welcome back, everybody, to Magnolia on Money. This is Ed Cox with your weekly market report coming in from our Magnolia Wealth studio. So today I'm going to discuss in detail and make this really, really easy. When you hear anything about the Federal Reserve and what they're doing this year, I want you to understand, number one, why we're at this place, okay, with the Fed, and how is this affecting you? All right. So let's start. I want to read real quick. I wrote it down so I wouldn't misquote our Jerome Powell, Fed chairman. Last meeting said this, and this is what's got the markets kind of up in arms. The committee is of a mind to raise the federal funds rate at the March meeting, assuming that the conditions are appropriate to do so. So that's from the Fed chair. That's what he said. Let's jump back. I want to explain how we even got to this point where the Fed's saying, hey, we got to raise rates, reduce our balance sheet, quit putting money in the economy. So I'm going to go back to my computer screen. So this is the federal funds rate. If you go back and you look at the beginning here, let me pull up so y'all can see my pointer. The Fed's funds rate in 2008, when we had the market crash from the real estate market that crashed, and then the Fed came in and said, okay, economy's not doing well. You know, things are really, really bad. First thing Fed steps in and does is say, let's reduce rates all the way down as far as we can. So essentially they put rates at zero. So what that does is that frees up money. That creates easier money supply for businesses and individuals. When rates are essentially at zero, you know, people can borrow money for a lot less, buy cars, buy houses. Businesses can start new ventures with that. So that's one of the ways they did it, try to get the economy back going. The other way is the Fed puts money into the economy through a process of quantitative easing. And in quantitative easing, what that is the Fed buys securities from the member banks. So the Federal Reserve gives cash in exchange for assets such as bonds. So the Fed has a balance sheet. They say, member banks, here's some money. The member banks gives them a security, typically bonds. And then the cash that the banks have, this extra cash, they can lend it back out. So that's what they did here in 2008. By lending the money back out, keeping rates really low, it kind of puts the money back in the economy, okay? And the banks can keep relending and relending that same dollar over and over and over. So you can essentially take a $1 trillion in Fed credit can become $10 trillion in economic growth through the relending process. So that's how they get money into the economy. People say the Fed is printing money. This is the process that they're really speaking about here, is one of them. So the issues we have is when the Fed reduced rates to zero, they kept them at zero too long, in my opinion. So when the economy got back on its feet, the Fed never raised the rates back up. So you can see all the way up until the end of 2015 when they started making adjustments and raising rates, all the way through mid-2019, rates came down a little bit, and then here we are, pandemic happens, rates went back down to zero. Put the pedal down. We're going to, not only are rates going back down, we're going to actually start purchasing more of those securities, putting more money back into the economy. And so that's what's happened. All right, so that brings us back to where we are today. And the Fed says, wait, the economy's back on its feet. We've got to get back to a normalized Fed funds rate, stop putting more money in the economy, and we have to shrink this $8.5 trillion balance sheet that the Fed now holds. Step number one, stop putting money in. So when you hear the Fed is going to start tapering, they're going to stop putting that money, giving that money to the member banks in return for those securities. So that's step one, quit digging the hole, and they're doing that. Step number two is let's start raising the Fed funds rate, which should affect interest rates on lending and other things. So what does that do? It starts to tighten the money supply. When rates go up, it's not as attractive for you to go buy a car or buy a new house or a boat. It's not as attractive for businesses to then open a new facility or invest in capital, human capital, and that sort of thing. So it makes money starts to become a little bit tighter. That's number two. And the third step in this process is to then take the $8.5 trillion that's on their balance sheet and then either let the bonds mature out or sell them or get their get the balance sheet lower. And that's how they do that. Let the bonds mature or sell the bonds in the market or the securities that they have. So they're starting this process. Jerome said it. I just read it to you. That's what they're going to do. How fast they do that, we don't know. They're moving ahead of schedule was what they said last year, so they're being more aggressive. How does this affect us? Well, when they shrink money supply and they, raise rates, you worry about the economy kind of stalling out. As long as they do this slow enough, the economy currently is in a position that it can withstand these rate hikes and money supplies tightening. We can withstand that, we really feel like right now, as long as they, do it at an incremental amount. And the Fed is actually doing all of this to get to a normal rate, but the main purpose is to reduce inflation. So get inflation in check. They're trying to get inflation down to 2%. Last year, December, it was 7% up from previous year. So, and that's the byproduct of keeping rates low for such a long period of time and pumping all this money in the economy. When you put more money into a economy, you create new money. The money that's already there is worth less. And when you have money that's worth less, it takes more of that money to buy products, which is inflation. So that's what's happening. The Fed's trying to rein this in. They started by tapering, which is they're not purchasing they're going to stop purchasing those securities or putting money into the economy. Number two, they're going to raise rates. Okay. So to make it a little bit harder or not as attractive to borrow money. And then the third thing you're going to see them do is reduce their balance sheet or sell those securities or let those securities mature. Okay. So probably do a combination of both, but that's what's happening. That's what's going on. I hope this helps you guys. Email me if you have any questions. You want me to go over a topic maybe next week. Email it in. Send it to Brooke, BROOKE at magnoliawm.com. Y'all have a great week. God bless. And I really hope this helped y'all as you hear more and more about this as we move through the year. But we'll be back next Monday, Tuesday to explain what happened in the market this week and give you more insight and what to look for. Y'all have a good week. God bless.